Well, hello and good afternoon. As always, we appreciate your time. Today, we're here to talk about the evolving sourcing landscape, examining policy change and how that already has impacted the U.S. apparel market. This webinar is offered through CottonWorks, which is Cotton Incorporated's resource for professionals throughout the cotton supply chain. This is a free resource available through a simple registration process. Content features not only educational webinars such as this one, but also trend forecasts and a massive library of fabrics. So please check it out if you're not already signed up. Hopefully everything will run smoothly today from a technical standpoint, but as a heads up, we will be answering questions after this webinar. So if you do have any questions, please feel free to submit them at any time through the Q&A feature that you have in your Zoom application. Also, I'd like to give you a reminder that a recording of this webinar will be available on the CottonWorks website after we finish up here. But to go ahead and get this show started, let's take a look and introduce the purpose. So what we're trying to do today is take a look at what policy changes have happened and when they've happened. I want to take a look at how they've been implemented, and also want to take a look at the data that has surfaced so far and can see what the effects have been on order placement and arrivals throughout supply chains. Before we do that, I do want to provide a little bit of context. Obviously, it's been a very busy year in terms of the policy change, but some of this is kind of an acceleration of what has been out there over the past several years. Always feel that context is important, and the changes this year have built on changes that have been taking place over the past few years. I think it is somewhat interesting to think that it was only in 2017 when TPP, or the Trans-Pacific Partnership, was completely overturned. So this was, less than 10 years ago. And since then, of course, we've come to these major tariff implementations and a definite move away from policies oriented towards increasing globalization and increasing free trade. But just for a little bit more context in terms of how dramatic these changes have been, we've had this thinking that, increasing globalization, increasing free trade makes a more safe and more economically viable world than what we have had in the past. And for that reason, since World War II, the U.S. has been leading efforts to try and increase international trade. Those initial efforts included broad global agreements like the General Agreement on Tariffs and Trade, or GATT, which set a lot of the guidelines or basis for the table of discussions around imports that continue to be in place even to this day. Later efforts pivot away from global types of policy change like we have with GATT towards more regional and bilateral focus, such as those including NAFTA, CAFTA-DR, and the bilateral agreement that the U.S. signed with South Korea. But something to point out is that even though we did have this period of globalization and the signing of free trade agreements over the past many decades, there has been occasional pushback. There's been concerns about the effects that could have on manufacturing sector here at home. Sometimes trade or labor unions have voiced opposition to some of these trade deals. And, once again, that culminated with the stalling of the Trans-Pacific Trade Partnership less than 10 years ago, which sort of put a nail in the coffin of that thinking that had us oriented towards increasing free trade, increasing globalization, and becoming a more globalized world. So a major policy shift that we've seen here over the past several years. And of course, a lot of changes that we've had here just in 2025. So if you take a look at, when the new administration came in, they didn't waste very much time in terms of starting to increase tariffs as they had been promising. What I'm going to be showing you here in terms of timeline are major events focused on effects that could impact the cotton supply chain, including apparel sourcing. So the first round of tariffs, once again, pretty soon after the new administration came in, occurring on February 1st, when we did see a 10 percentage point addition on imports coming in from China. In response to that initial announcement, there was limited Chinese response. But about a month later, after the U.S. announced another 10 percentage points increase in tariffs on shipments coming from China, we did see China respond with 10 to 15 percentage point increases on imports it gets from the U.S. This did include a range of agricultural commodities and did include U.S. cotton shipments to China, with tariff rates going up 15 percentage points relative to duties that other cotton shippers are paying into China. Of course, a big announcement came about a month later with the Liberation Day or reciprocal tariff announcements that occurred on April 2nd. In response to the U.S. announcement, China made parallel increases in their tariffs. We did see, acceleration in those tariff rates or further additions, with the U.S. increasing rates on China as much as 125 percentage points relative to what was already there. China responded with parallel increases, increasing its rates on U.S. cotton, among other goods, as well during that time period. Soon after, the U.S. dropped its reciprocal rates for most locations, for those outside of China, to just a 10 percentage point increase. It was a little bit later in May when we said the U.S. and China back off a little bit and decrease some of those reciprocal tariffs that they had put in place in early April. That put the U.S. increases on duties coming from China to 30 percentage points for all of 2025. So it's a stacking of the 10-point increase from February on top of the 10-point increase in March, and then another 10-point increase in April in terms of how that math works. China maintained its duty rates on U.S. cotton imports at a level higher than it was at the start of the year, at 25 percentage points higher than where it is for other locations shipping cotton to China. Other news, of course, has happened since then. In early July, there was an initial deadline for negotiations around those April 9th reciprocal rate decreases. We did see letters being distributed around that time, and we did see an extension in terms of the deadline for negotiations by another month. Those were supposed to go on till the start of August, but on July 31st, we did have an executive order that got ahead of that, and it detailed increases in tariffs for most countries around the world. The exception, of course, being China, which has a little bit of a different deadline. The negotiations that are going on with China are expected to conclude sometime by early November. So we will have more details on longer-term rates potentially in effect for China here in a couple months. But the point of all this, is not to dwell on all the details regarding all these announcements, but really to just show how busy of a year it's been. We've got, two columns here in terms of our tariff changes, and we've completely filled up a slide with the tariff rates that have moved around this year. Before we get into some of the effects on the supply chain, I do want to take a little bit of a step back. One point of this webinar is to provide a little bit of context or discussion around tariffs and the ins and outs in terms of how they have been applied. And a bit important part of that are the legal justifications that have been used to help put these tariffs into effect. For a little bit of background here, I want to provide a little bit of discussion regarding some options that maybe are a little bit less relevant now, but could be more relevant later. And that is, some of these other justifications that have been used in the past to help justify tariffs. So if you do hear discussion around 301 tariffs or Section 301, this is referring to some justifications that have been used previously. In the first round of the trade dispute in 2018 and 2019, Section 301 was what was used to justify those tariffs from a legal standpoint. Somewhat interestingly, maybe here is that these 301 tariffs are based on accusations of unfair trade practices with a partner country. The organization within or agency within the U.S. that makes that determination is the U.S. Trade Representative or USTR. For the USTR to make that determination, they're required to make an investigation and to have consultation with that foreign government. This important distinction here regarding consultation and investigation is that it requires more time. And when we take a look at the tariff increases that occurred in 2018 and 2019, those investigations and consultation periods took 11 to 12 months. So it can be a substantial amount of time. And because of that time, it maybe wasn't the avenue that was pursued in the current round of tariff increases. But something that has been used in the past. Something else that you may hear relative to legal justifications for tariffs is Section 232. Maybe a little bit less relevant here for cotton supply chains or apparel sourcing, in that this is based on national security concerns. Similar to Section 301, it does require a determination with investigation and consultation. Here with Secretary of Defense and Department of Commerce, as opposed to consultations with a foreign government. But just want to highlight that it does require, some groundwork that can take some time. Even though it can take some time, Section 232 tariffs have been put into effect in the current calendar year. It has been used to justify some of the tariffs that have been put in place, primarily on metals, which could potentially be used to make goods used in defense. But the last legal justification I want to cover is the one that has been used on the most widespread basis in 2025 or in the current round of the trade dispute, and that is the International Emergency Economic Powers Act, or what you might hear out there as IEPA. To take a little bit of a step back, all of these legal justifications grant some power to the president to potentially, or agencies under the president to potentially change tariff or trade policy. We look at the Constitution, the official power to manage foreign trade actually goes to Congress relative to the president. But Congress also has the ability to delegate some of that authority, and they have delegated that authority at different periods in time. The IEPA actually comes from a very old statute, the Trading with the Enemy Act, which dates all the way back to World War I. IEPA evolved out of that, actually clawing back some of the powers that were granted to the president during emergencies such as war. This was done during the Nixon administration when they're trying to roll back some of the president's authority. But regardless, IEPA, since it was introduced in the 1970s, it has been a central component of the modern U.S. Sanctions regime. It has been how we've been able to justify sanctions and embargoes over the past several decades. But what's been happening more recently, has been justification for reciprocal tariffs. Did require some declaration of emergency. The emergency that has been declared is that the U.S. Manufacturing sector has been significantly damaged, and therefore we need tariffs to help protect against the consequences of that. But there are some questions about whether or not IEPA actually gives the president the authority to change tariffs. So if you go through the executive orders that have been issued throughout this year, many of them involving tariffs, in the first paragraph will say, due to the authority the president has under IEPA, it can issue these tariffs. But courts have questioned that. One of the courts that have questioned that is the Court of International Trade, or CIT. The Court of International Trade is the official forum that we have to manage disputes around tariffs. When the Court of International Trade looked at IEPA in the context of these tariffs that have been announced this year, it found that IEPA does not grant unbounded ability to the president on tariffs. So what this means is that there may be some limited authority. If you go back to when IEPA came into effect around that Nixon era, there was some use of IEPA to play around with tariffs, but since then it really hasn't been used at all, and that whatever was used in the 1970s was very limited as well too. So what this court said is maybe there's some ability, but not unbounded ability, not ability to make widespread tariff increases that could endure for unknown periods of time. A separate ruling that came out in late May was out of a district court in D.C. It found that IEPA doesn't apply to tariffs at all. They went through the IEPA document, the text itself. They didn't find the word tariffs in there. They didn't find the word duties in there. They didn't find anything that referred back to potential to manage tariffs at all. For that reason, they're saying that this district court has jurisdiction, not the Court of International Trade, which is set up to make rulings around tariffs. It's a little bit of a jurisdictional dispute there on top of some of the questions around the legality of all of this. Here, just a few weeks ago, we did have a Court of Appeals in the Federal Circuit uphold the decision from the Court of International Trade. It then took a look at those and decided that tariffs will continue to be in effect despite it being illegal. And then this went back to appeal all the way up to the Supreme Court. And the Supreme Court said just about a week ago that it will hear arguments from both the CIT case and the district court case and the appeals case sort of jointly together sometime in early November. So just want to give you some context from the discussion out there. If you haven't gone back and read some of the underlying source documentation regarding some of these court disputes, just probably a little bit of context for that, and to indicate that both these cases are expected to go to the Supreme Court in arguments beginning in November. So that's what's been happening in terms of, how these tariffs have evolved or have been introduced and presented over time. Here, we want to get a little bit into the numbers and taking a look at what these rates are and how they've been applied. And later, we'll take a look at the data in terms of how it's been affecting sourcing patterns. But to start us off, I've got what admittedly is a little bit of a complicated table here. But if you want to take a closer look at it, you always can circle back to the recording that we'll have on CottonWorks shortly after this presentation to look at the numbers in a little bit more detail. But what you have up here in the leftmost column, you've got the percentage of cotton apparel being imported from different countries in 2024. So to give you an idea about market shares. And then what you have in those columns over to the right are the series of tariffs that have been announced at different points in time. So the April 2nd announcements were the ones that were introduced by the White House on those posters out in the Rose Garden on Liberation Day. And we do leave some room for evolution there in terms of the increases in China. One step over, you have the April 9th increases. For China, of course, that reduction occurred in May rather than on April 9th, but you can see that we had 10-point increases for most locations outside of China on April 9th, which was lower than where they were on April 2nd. And then on July 31st, we had another table of releases regarding tariff rates that would be applied beginning in early August for a wide range of countries, and you have those duty rates there now. So once again, this is a busy table. I don't expect you guys to be able to really read this and process it immediately. You can circle back to it if you want, but just to make a few high-level points, when we take a look at the July 31st increases in tariffs, all of those were lower or equal to what was announced on April 2nd. So there were no increases relative to where we were on April 2nd, although many of those were greater than or equal to what they were on April 9th. We take a look at the average rate of increase that was introduced on July 31st. It's around 20 percentage points, which of course is higher than the 10 percentage points that went into widespread effect on April 9th. Something else to highlight is that negotiations are still ongoing. There was an executive order that came out in early September detailing that deals are still possible and there can be some potential adjustments to these tariff rates depending on what happens in those deals. Something that we have been watching are the potential for some incentives regarding U.S. agricultural sales to some of these markets. In Indonesia, and a deal that was announced in the details, they did indicate that they were going to be increasing their purchases of U.S. agriculture and specifically cotton. Other markets may do the same. Japan said it's going to increase its purchases of U.S. agriculture, but they're not a big buyer of U.S. cotton right now or cotton in general. So less consequences there for the supply chain. But with that, we took a look at the numbers. I want to take a look at how these numbers are actually being applied. I think there can be some confusion relative to how these tariff increases are discussed in the media and how they actually go into implementation. As a numbers guy, I do pay attention to some of the terminology or details around numbers and how they're described. And an important detail is that all these changes are in terms of percentage points and not in terms of percentages themselves. And that makes a big difference in terms of the rates of that are being paid in terms of tariffs. So for an example, we'll start with a cotton dominant t-shirt. Base tariff rate for a cotton dominant t-shirt at 16.5%. This is the duty rate that was in effect before any of these changes that occurred in 2025 or even independent of the changes that occurred in 2018 and 2019. If we were to add that 20% addition, which was generally the average of what we saw coming out of July 31st, increases, that addition would bring the tariff rate on average for a cotton dominant t-shirt to 37% or nearly 37%. And this gets back to our discussion about percentage points versus percent change. If there's a percent change, that 20% change would only bring us up to a level that's significantly lower than the 36.5%, which is currently in effect. Something else to highlight is that, it's different for different countries. Of course, each country has a specific rate right now, but definitely different for China. And this is even going back even further. So if you remember the first round of the trade dispute, we did see consumer goods starting to face higher tariffs in September of 2019. Initially, those tariff rates were set at a 15 percentage point increase, but they were lowered by half to a 7.5-point increase with the signing of the Phase 1 deal. But an important element is that even with the Phase 1 deal, those tariff increases remained in effect, and those 7.5 additional points have been in effect for the 5 years since that initial round of the trade dispute. And then on top of that, we have the increases that occurred this year, 10 points in February, 10 points in March, another 10 points from April, May, some negotiations that came out, bringing the tariff rate for a cotton dominant t-shirt potentially coming out of China to over 50%. Something else that you may or may not be aware of is that when you take a look at the different classifications we have in our tariff schedule, there are differences in tariff rates according to the fiber content of those garments. So we take a look at the duty rate for a cotton dominant t-shirt is different than what we see for a man-made fiber t-shirt, and that rate is significantly lower. So something else that may be of interest when you're looking at your sourcing decisions is looking at costing decisions. So base rate for a man-made dominant t-shirt before the tariff changes at 32%. To that, we added 20 percentage points, bringing the average import duty rate across sources to over 50% for a man-made fiber t-shirt. For China, things a little bit different. Of course, the rate increases were there for a longer period of time. And to that, we did add more this year, bringing the current duty rate for a man-made t-shirt coming out of China to nearly 70%. So obviously dramatic changes in tariff rates, which would be very familiar to any sourcing professionals that may be joining us here today. But something I wanted to highlight, some of those a concern for us is that, when they're talking about reciprocal duty rates was whether or not cotton dominant products would retain their tariff advantages relative to man-made fiber goods. And that certainly is the case when we take a look at the additions that have been made to tariffs in 2025. Here's just to pull another example. So if you do want to see other examples, this cotton dominant advantage does span different product categories. So beyond t-shirts, we also can take a look at woven pants, and I pulled them here for women's woven trousers, which would include garments like jeans. And, once again, you can see cotton dominant items have lower duty rates than their man-made fiber counterparts. So with that, we got some nuts and bolts. We've seen how the math works regarding tariffs. Now we can actually look at some trade data, and we are several months beyond these tariff increases, so we can start taking a look at some of the effects of these tariff changes. We've got a relatively long time frame here in this chart, just to give you some runway to take a look at the perspective on change. And before I get into changes in duty rates themselves, I just want to highlight a few different time periods because there have been different time periods that are important relative to changes in tariff rates. So the first one date goes back to the first round of the trade dispute between September of 2019 and February of 2020. We did have tariff rates on China up 15 percentage points. As we signed a phase one deal for the many years that followed up to the mostly up to the present, we saw China paying 7.5 percentage points only on top of the base rate. Then here more recently, we have 2025 tariff increases. So that pink part of the shading there is referring to the time period after February when we started to see tariff increases in this current round. So on top of that, we can take a look at average duty paid. This is coming in from trade data that we access actually through international trade statistics through the U.S. government. These are official duty numbers coming in. They do indicate that they are somewhat estimated, but should be a reflection of average tariff rates being paid on both knit and woven garments. So take a look at numbers for China. You can see the bump that we had with the 15 percentage point increase that occurred early on in the first round of the trade dispute. You also can take a look at how things stair-stepped higher for many of the past several years, with tariff rates on Chinese goods up 7.5 percentage points. Then you also can see the 2025 increases, with that peak there being for April shipments before we saw some of the discounts that were applied in May. And then you can see where tariff rates have been over the past couple months in data. The last data point we have in these charts is for July, just due to the lag in the way that import statistics are reported. But I just want to highlight that we can do these numbers for China. We can do them for other geographies too. Here's a global average tariff rate being paid for apparel coming in, and it's up about 10 percentage points. We can do it for other specific countries if we want to too. So we can zoom in on Vietnam. We can zoom in on Bangladesh. And if there is interest, we can zoom in on individual product categories in addition to these country averages. So a little bit of perspective in terms of how duty rates have changed. And of course, what stands out is how much more duty is being paid from China relative to other sourcing locations. So once again, these data are lagged about a month or two. The latest data, which came out in early September, reflective of shipments that came in July, which means that those July 31st increases that went into effect on August 8th are not included in these data. So we will see these average duty rates move higher as we get further into the future and have more data available to us. But in terms of averages, if we take a look at the average duty rate that was paid by China in July, it was 51%, which is about 30 percentage points higher than it was in 2024. That was what has been announced, and that is what's showing up in terms of our trade data. Similarly, for both Vietnam and Bangladesh, we're seeing these duty rates up about 10 percentage points higher relative to where they were in the 24 calendar year. You do note some differences there in terms of the average duty rate being paid by Vietnam, Bangladesh. Some of that's just due to differences in the product mix. So you take a look at the difference in the base rates that we had for t-shirts versus woven trousers coming in on the previous slide. The difference in the product mix that we're sourcing from Bangladesh or Vietnam driving some of the difference that you're seeing there in terms of the average duty rate. So the question is, if we had a change in duty rate, what does that mean for change in import volume? And that's what I'm showing you here. These data are in terms of weight volume, so it's the weight of apparel coming in, but it is a volume measure. And we do see, as tariffs went up on apparel coming in from China, we did see shipments decrease. And if we take a look at the latest 3 months of data relative to where it was on average in 24, we're seeing shipments coming in from China down 35%. So tariffs already having a significant bite in terms of impacting how sourcing is occurring from China. We take a look at these other locations. We still got Vietnam and Bangladesh in there in terms of our green and blue lines, seeing some stronger growth from Vietnam in percentage terms relative to what we're seeing from Bangladesh. But that overall volume from Bangladesh holding up at a little bit higher level than what we're seeing from Vietnam. So we're able to track changes in duty rates. We're able to change changes in apparel shipment volumes too, just to see what's going on in terms of the sourcing picture. We have taken a look at that, a little bit zoomed in terms of different geographies we can examine. Here's just a global view of what's been happening in terms of tariff changes. So take a look at the global duty rates on the chart on the left. You can see that things went up about 10 percentage points from somewhere around 15 percentage points to somewhere around 25 percentage points as they moved into that red area of or pink area of 2025 tariff increases. And then we take a look at the picture of what's happening in terms of apparel sourcing. It's a little bit more complicated. We're up about 6% versus the average in 2024. But in 2024, we did have some depressed shipping volumes, particularly in the first half of the year. But if we just zoom in on what's been happening on months since tariffs started to rise, we can see that we did have a dip. So this was down in May, but then we came back up in June and July. If we take a look at where we are in terms of the range of recent years, we started out from a high point, then went to a low point, and where we've been, at least in the past couple months in terms of shipment volumes, is pretty much near the middle of where we've been in recent years. So maybe relative to those higher values or maybe potentially front-loaded values that we had before tariff implementation, we have seen imports decrease, but they maybe haven't collapsed as much as we would expect, given some of the fears that are out there or concerns that are out there regarding all the costs involving tariffs. Some other things that might be interesting is to take a look at what's happening further downstream. So sourcing costs have increased. If we've seen, apparel prices or duty rates go up 10 percentage points or a little bit more than that, have we seen any impact in terms of retail prices yet? When we do take a look at average retail prices, and what I'm showing you here on the right chart, on this chart on the right-hand side, is the CPI for apparel over time. And when we take a look at current values, they are high relative to where we've been, particularly during the COVID era. And they're actually the highest we've had since the early 2000s. But if you take a look at the magnitude of the increase, they're only a little bit higher than where we were back in 2012, 2013. And if we take a look at, a lot of the upward movement we've seen in apparel prices over the past several years, it's more reflation after the big dip we had with COVID rather than inflation. So that maybe could be something interesting to think about in terms of effects of these duty rates. Something else that may be interesting to think about is, what happened in that first round. And part of the reason why I wanted to do some highlighting around these previous periods of changes in tariff rates is just to highlight what happened further down the supply chain and at retail when we did have those tariff increases on China back in 2019. And when we did see those tariff increases on China back in 2019, we actually didn't see retail prices increase. We actually saw them decrease. And I think part of the reason for that is that, retail prices aren't just a function of sourcing costs. There's a lot more that goes on between sourcing and consumer purchasing. And something that was going on back then was that the economy was slowing, and due to some maybe slowing down in the economy, prices actually eased somewhat to help move product at the retail level. So it'll be interesting to see, future data points and see how this continues to progress. But this is at least what has happened in the past according to government data. Something else I wanted to do relative to retail prices is just provide some context for changes in apparel prices relative to changes in overall inflation. So in that chart on the right, I've just shifted the axis a little bit, but it's the same data. The light blue line that I added there is the overall inflation rate. And this is getting back to the point of, reflation after COVID in the apparel sector, while we have had general inflation out there in the wider economy. And when we think about apparel only being about 2% of overall spending, and when we can think about some effects of sourcing costs associated with tariffs and potential impacts on consumer spending behavior, some of the effects that it may have on bigger pieces of the consumer spending pie beyond the 2% that's represented by apparel could have more potential to impact consumer spending on apparel than changes in apparel prices themselves. So something else we'll be paying attention to, in addition to any movement in retail apparel prices with changes in duty rates, is what's going on in the overall inflation rate and what that may be meaning for consumer spending on apparel beyond what's going on in apparel prices or apparel sourcing costs. When we do take a look at the sourcing market, or we do take a look at also some factors downstream, there is a interesting mix, I think, of tailwinds and headwinds that's out there right now. One tailwind in terms of order demand, or one argument that could be made supportive of continued strength, or some contribution to strength in apparel imports, would be what has been happening in the consumer market recently. So in the chart on the left, we've got the same time frames highlighted. I've got a green line there that is showing you inflation-adjusted consumer spending on garments. So this is a rough reflection of the quantity of apparel being purchased by U.S. consumers. The dark blue line over there is showing you a 3-month rolling average of apparel imports. And something that's been really interesting is the difference that we've had between those two lines over the past couple of years. It represents several million bales of apparel in terms of weight volume that have not been coming in, that maybe could or should have been coming in if it was going to keep up with consumer spending. There's a couple of key factors that probably have been driving that difference. One of them is de minimis. Those de minimis shipments, which were increasing in popularity over the past several years, are not counted in our official trade data, and therefore aren't showing up in that dark blue line that we have there on that chart. But another important piece of that separation is some inventory adjustment. We've had a lot of change in the macroeconomic environment in the U.S. in recent years. And one of the biggest changes we had was the whipsaw reversal from a highly stimulated environment when consumers were spending money, they were okay paying higher prices with their stimulus dollars, to one when all of a sudden we were paying attention to inflation, we had higher interest rates, and there was concern about inflation. During that really sharp transition, we did see some effects on inventories. So orders continued to come in as the economy changed really rapidly. And as orders came in, we saw a big buildup of inventory, particularly at the clothing wholesale level in the U.S., which is what you're seeing in that light blue line in the chart on the right. And what we have had is a period of drawdown throughout 23 and 24. And that period of drawdown meant that inventory was being used instead of new import shipments. And it's only been over the past few months that drawdown process has appeared to start to wind down, with some of those inventory sales ratios at clothing wholesalers now representing levels where they were back before COVID. So it looks like the drawdown is down, and if that drawdown of inventory is done, then we will need imports to keep up with consumer spending, and that could be something that could support imports, even with some concerns about sourcing costs here with tariffs. So that's something that we're watching as a potential tailwind for some import demand, which of course will have to be counterbalanced against the cost effects from higher duty rates. Something else we're looking at has to do with the mix of apparel imports that could be happening. What I'm showing you here is the share of square meter equivalents that was imported from different sources for cotton dominant and man-made dominant apparel in 2024. And when we take a look at the product mix across fiber and across sourcing location, what you see is that there's a lot greater diversification in sourcing for cotton apparel relative to man-made dominant apparel. Some of that, of course, has to do with some of the concerns that have been surfaced around forced labor and cotton coming from China in recent years, but that has encouraged, some diversification in sourcing, which may make cotton more better positioned relative to some of the challenges around tariffs, particularly if we're going to see tariffs from China potentially rise further as we get through this next round of negotiations. Another factor that could be contributing to the prevalence of man-made dominant apparel imports from China is just the fact that China produces a tremendous amount of polyester, and that polyester is making it into their product that they're sending to us in the U.S. So we take a look at differences in sourcing patterns across fiber. We've done that, just China compared to the rest of the world. Here we can add a few other locations, but I also want to point out how this has been contributing to changes in sourcing dynamics or product mix, at least in terms of what's coming into the U.S. over the past couple months. We did talk about the pullback that we've seen from China. These numbers are in terms of bale change recently compared to where they were in 2024. When we do take a look at the change in cotton shipments coming from China, it is smaller relative to the change that we've seen in man-made apparel coming from China. Some of that due to the product mix there, but some of that also due to diversification that's available from other locations. One location where we have seen sourcing move a little bit higher is South Asia. So this is Bangladesh plus India and Pakistan. These are countries that do have a strong cotton heritage, and we are seeing a stronger cotton share from sourcing from these markets, and that increased share of South Asia is resulting in some increase in cotton share in terms of shipments here recently. For ASEAN, which of course is South Asia, we take a look at the volume of cotton and man-made apparel coming in. It's relatively even, so that's not moving the needle in terms of fiber share of garments too much. Similar with Latin America, they are a little bit more cotton heavy than they are man-made heavy, but not moving the needle too much either. But this sort of dovetails with some of the discussion we had earlier relative to Bangladesh and Vietnam, some more regional level instead of country specific. But when we do take a look at the decreases, that have been occurring in apparel imports from China, it's being displaced by South Asia and Southeast Asia predominantly. And despite all the discussion about increasing sourcing from Latin America, we have not seen sourcing from there tick up even after tariffs have started to increase. So to start closing this discussion down, we've been narrowing down our discussion a little bit, taking a little bit closer look at effects on sourcing volumes and costing throughout supply chains. And as we bring that to a close, we'll just start at the very beginning of the cotton supply chain, and that is with cotton prices itself. So here you have prices for cotton, and I just want to highlight how cotton prices have reacted to these many tariff announcements that have come out so far this year. So these gray bars are indicating different announcements that came out in different periods of time. And what you'll notice is that there really has not been a tremendous effect. We did see some lows being tested when China put those tariff increases on U.S. cotton in response to some of the tariff increases we had on Chinese goods. But, some downward movement with a surprise on April 2nd, some upward movement after things got a little bit easier after April 9th. But by and large, the market really has not been responsive to these major announcements regarding macroeconomic policies, which certainly can have impacts on sourcing for apparel goods. And if you take a look at the cotton market, it really has been moving within a range of 4 to 5 cents per pound since all these tariff announcements started back in January of this year. So when we start thinking about maybe a silver lining relative to all the uncertainty that's out there, one of them is that fiber prices, have migrated to lower levels. They've been stable at those lower levels, and due to some supply demand issues, which could be a subject of another webinar, we do expect them to stay at these lower levels, at least for the foreseeable or forecastable time period. So this may help offset some of the cost pressure from tariffs in terms of lower raw material costs. But a dominant theme, you take a look at, these policy or tariff implementations, is that there's continued uncertainty out there. The Supreme Court decision is the next known variable. Expected to start hearing arguments in November. What I've heard the legal experts say is that it may take several months for those arguments to get resolved, and it may take some time for any changes that may come from their decisions to take place. In the meantime, we've got some questions out there regarding, where import volumes might be. Some of them, are related to what I was talking about, the tailwinds with consumer spending being higher than what we've seen in terms of apparel shipment volumes in recent years. Inventory drawdown looks like, we maybe have been completed, and that may help motivate some orders, even though there are all these cost concerns out there. But I think on top of that, we've got questions about the macroeconomic situation. If you remember back to our discussion about retail prices at apparel that we had on one of those slides previously, the economy was slowing down then. Back then, we did have the administration pressuring the Federal Reserve to lower interest rates somewhat like they're doing right now, due to the fact that there were concerns about economic growth. Something that has been supporting consumer spending in the U.S. over the past couple of years has been a very strong labor market, but recent labor market data has been a little bit weaker. So there are some questions about that, which could potentially weigh on orders in addition to sourcing costs. But some other points just to make, relative to the product mix, is that tariff rates for cotton apparel have been and continue to be lower than they are for man-made apparel, and that cotton apparel may have some advantages in terms of diversification for sourcing, and that, due to some other policies independent of tariffs, that cotton has increased its sourcing, particularly locations outside of China, over the past several years. So with that, we've covered a lot of grounds relative to discussion around tariffs, and I hope we have some opportunity now to look at any questions that you guys might have. So just give me a second. I will bring up the question and answer box if you do have any other questions out there. Looks like the one that came up was really that is there going to be a recording available for attendees later? And the answer is yes. Give us maybe a day or two to get it posted, but it should be appearing on CottonWorks relatively soon. So I'll give you guys a chance to maybe look for that question answer, that question box. If you do have any questions, please drop one in there, and we'll take it. Otherwise, I could give you guys a few minutes in your day back. So. All right, well, we're going once, going twice. Oh, here comes one. All right. So how does the Fed rate cut and higher tariffs affect the market? So I think, some news. So we had a Fed rate decision that came out yesterday. They did decide to decrease interest rates for the first time that they've done in about a year. And I think, the Fed's trying to thread the needle. I'm sure it's like a lot of our sourcing specialists out there as well, too, just trying to figure out, which way is the economy heading? The consumer in the U.S. has been holding up really well over the past few years, once again supported by the labor market. These labor data have been a little bit softer, but then the Fed also has to look at inflation, and inflation ticked up a little bit higher last month too. So the Fed's trying to thread the needle there. And I think, some of the indecision that was reflected by Federal Reserve comments and by the fact that they reduced rates only by a quarter point relative to a half point is indicative of the uncertainty that's out there. I mean, the Fed's obviously going to have to balance the same factors that we're talking about, cost and inflation versus overall economic health and what that might mean for the economy. So thank you for the question. Seen a few more coming in. So why is the price of cotton remain relatively stable with so much pressure on large cotton consuming countries like China and India? What's the role of tariffs there? So in the cotton market, there's a little bit, it is a separate topic of discussion, but to go there very briefly, when we take a look at cotton price direction, it has migrated lower, actually further into the past. So, one of the ways I've been trying to explain it is that if you're at the bottom of a hill, maybe you have less room to drop than if you were at a relatively high place. And if you take a look at cotton prices, they've been moving lower since early in 2024, where they moved from levels around $1 down to levels where they are now below 70 cents per pound. And if we take a look at reasons why cotton prices moved lower back then, some of it had to do with a big pullback in import purchases from China. So China bought 15 million bales if we go back 2 years ago. More recently, they're buying about 5 million bales. So a huge reduction. And that's affecting, the world. It's not just affecting the U.S. and some of the tariff challenges that we have in terms of selling to China. It's also affecting Brazil, which continues to pull out record crops. And the availability of exportable supply from countries like Brazil and the U.S. when China pulled back from the market um, is a reason why cotton prices have been low. Since that supply continues to be out there, that's keeping a lid on cotton prices. And when we take a look at the outlook ahead, it's going to take a while to get through some of that exportable supply to get prices to increase. So um, there's a lot of cotton supply out there. I think is the long answer, and it's going to take a while for it to come through. And I think the fact that cotton prices already moved lower is part of the reason why they haven't decreased with these series of tariff announcements. Okay, so another question about some sourcing relative to forced labor concerns, maybe potentially cotton produced in China. How is that affecting the global price situation? Well, I think it's something that has, created concern around sourcing. It's increased the importance of traceability. Of course, all the retailers and brands are very familiar with that. It's also, raised some questions about how China is going to conduct their cotton imports. What we have seen is that China had imported, and they've imported from locations including the U.S. over the past few years. We're talking about that surge they had a couple years ago. There's a lot of U.S. cotton that went there. So there have been some impacts, but when we take a look at a lot of the cotton that's produced in China, a lot of that cotton is staying within China. All right. So those are the questions we've got. Maybe give you guys another 10 seconds or so, and then we'll go ahead and close things down if nothing else comes in. Okay, so one more question. Maybe this will be our last question, but a question about, are retail prices expected to go up due to tariffs? I think in aggregate they are. I think that's been a big concern that the Federal Reserve's been looking at. They were expecting some temporary increases at retail at large due to tariffs and their widespread impacts. So here I'm talking about apparel, beyond apparel, but everything. Um, I think that, those expectations are in place, and we may have already witnessed that with some of the tick up that we saw in inflation in the most recent data. I think when we take a look at the retail environment for apparel, it's a little bit more complicated. Obviously, there's margin pressure being introduced by the introduction of these tariffs. Of course, to preserve margins, you want to increase prices, but that's going to have to be balanced out against the consumer environment. And I think to see the extent that any of these costs are passed on will have to do with the strength of the labor market and the consumer's ability or willingness to pay higher prices for apparel if they're getting pinched from prices in other goods categories. Okay, so we did see another question come in. What do we see happening with India? Do we expect to see the 25% additional penalty to be dropped by November? That's a great question. I think that you know an important part of that question goes back to our discussion about the legal justifications for tariffs. So if we take a look at the IEPA being used as a tariff justification for the additional 25% that went on Indian goods because of their purchases of Russian oil. That's a little bit of a different argument than what we're seeing regarding protection of U.S. manufacturing under IEPA. Maybe that could go under some sort of defense-related justification, like a 232 justification. But all that gets into legal arguments that are a little bit beyond my scope as a numbers guy. So I'm happy to have some general discussion around some context. But I think that is an important question that the Supreme Court's going to have to consider. Are all these IEPA justifications going to be universal, or is it going to be applied on a country-to-country basis, given there have been different executive orders regarding these tariff increases? Okay, well, thank you guys giving you guys a little bit of time to get some questions in. I think we'll probably wrap things up here. But once again, I want to thank you all for your attention and for your time, and hope to see you on another one of these webinars sometime soon. And I wish you all good luck out there.